Great. So now, ladies and gentlemen, I'm looking for the famous Baumol. I'm 100% sure that you guys are already good at this. I'm even wasting time. I'm even wasting time. I'm even wasting time because Baumol, this EOQ thing, everybody will be able to get it. Baumol, the advantages, disadvantages, everybody will be able to get this. So I'd rather right away go to what we call Miller-Orr model. Miller-Orr model. And a Miller-Orr model, I would want us to do this small example that is here. You're able to see, and you can screenshot this. The following data applies to a company. The minimum, sorry, somebody is doing something there. Disable annotation for others, yeah. So the minimum cash balance is 8,000 US dollars. It's in dollars, but of course you can read this as shillings. Yeah, so they've given me the lower limit is 8,000, that is minimum. The variance of daily cash flows is 4 million, equivalent to a standard deviation of 2,000 per day. The transaction cost for buying or selling securities is 50. The interest rate is 0.025% per day. You are required to formulate a decision rule using the Miller-Orr model. Now, ladies and gentlemen, this kind of a question is so simple. You're even telling me, Mwalimu, please, Mwalimu, don't do this question because it is very easy. Let me just do it for the sake of some students, ladies and gentlemen, who have not gotten an opportunity to really do this. Yeah. So here, what you're supposed to do, ladies and gentlemen, is to appreciate the formula of getting the spread. Let's get the spread together. So how do we get the spread? So to get spread, ladies and gentlemen, I'm so sure you guys know the formula. It will be 3. If you remember very well, it will be 3 into, in this case here, 3. Yeah, 3t variance, yeah, all over 4i. And then at the end of the day, we have a third raised to power a third on top. Raised to power a third on top. This is how we get the spread whenever it is Miller-Orr. All right. So remember that T is a transaction cost. This is variance. This is daily interest rate. Daily interest rate. So in this particular case, then, our spread will be 3 into 3 times the transaction rate. The transaction rate, they want me to adjust the board. No, remember, so long as you're able to see something, however small, so long as you're able to see something, however small, you shall not, so long as you're able to see something, however small, so long as you are able to see something, however small. So are you able to see, ladies and gentlemen, here that the transaction cost is 50? Transaction cost of buying and selling shares is 50. And then here, they have given me the variance, which is 4 million. 4 million, 4 million. All right. Everything here divided by 4 times the daily interest rate. The daily interest rate, you can see it is 0.025 over 100. The daily interest rate is 0.025 over 100, like that. And then remember, at the end of the day, we shall be able to raise this to a third. We shall be able to raise this to a third. We shall be able to raise that to a third. So there are so many ways of doing this. Now, please listen. If I'm the one who is doing this, I will be able to reformulate this. There are many ways. One of the ways of doing this is coming to the denominator, you multiply by 100 and here also by 100, like that. So that now this and this cancels out. So that when I take my calculator, first of all, I'm doing what we have in brackets. So I will say 3 times 50 times 4 million times 100 divided by, I open brackets here for the denominator. I will say 4 times 0.025, denominator I close, and then I get some funny answer. That funny answer, first of all, I will be able to go and raise that funny answer. I raise it to 1 over 3. Put this in brackets. The funny answer I get there, I raise it to 1/3. And then, of course, now once I've been able to evaluate this, I'll be able to come and multiply this with 3. Multiply this with 3. Is there somebody in this case here who has an answer for Mwalimu? For Mwalimu, anybody who has an answer? Remember, the 0.025 is over 100 because it is 0.025%. Whenever we are marking this, we always get so many guys getting errors here. We get so many people getting errors here. Is there somebody who is able to give me the final answer? So in this case here, Collins, they're getting 25. They're getting 25. 25,303. 25,303. That is the correct answer. 25,303. If you're not getting that 25,303, then you are wrong. 25,303. 25,303. Where did the 100 come from? Higher. Asante sana. Napenda wanafunzi ambao wanapenda kuuliza maswali. The other way round, remember before I answer your questions, the other way round, ladies and gentlemen, of handling this, remember we are saying we can come and leave this one here like that. We can come and leave this one here like that. So remember this is 0.025%. 0.025%. There is a student who is asking which question are we doing? We are doing some funny question. It's an ACCA question. Is an ACCA question. You're doing it from here. This one here. So please take a screenshot. Please take a screenshot. Everybody shall take a screenshot and then they share it in the WhatsApp group. In the WhatsApp groups like that. They share this in the WhatsApp groups. They share this in the WhatsApp groups. So I believe that has now been done and Mwalimu can take now a few minutes to explain this further. Now my good students, please listen. Another student will come and tell you, Mwalimu, but let's simplify this. So if we simplify this, this is 0.025 over 100. You see, this is the same as 2.5 times 10 raised to negative 2. This one here, because of 1, 2. Yeah, divided by 100. So then this one will be the same as what here? This will be the same as 2.5 times 10. This divided by 100 is pushing this to negative 4, Yeah, so raised to negative 4 like that. Standard form. And then I remember from high school, we were told in high school, when you see this is raised to negative 4, then these will be the same as writing 4 zeros. You write 4 zeros, and then you put 25. You write this negative 4, write 4 zeros, so you put this decimal there. Don't add another 0. So then, Mwalimu, what are you saying? So instead of writing this one like this, you'd rather come here and say 4 times 0.00025 like that. 25 like that. Mila ora, like that. So can we then kindly do this together? So remember, first of all, you leave these 3 outside, Leave these 3 outside, open brackets. You say 3. We are now doing these, all of us, even if you got the earlier one correct, all of us. We say 3 times 50 times 4 million divided by, always remember that the denominator must always be put in brackets. So we say 3 times 50 times 4 million divided by, open brackets, 4 times these, close brackets. Whatever we get a funny answer, go ahead and raise it to a third. Whatever you get, funny answer, go ahead and raise it to a third. So you say raise to a third in brackets. And whatever you shall get, you say times what here, somebody? You say times 3. Are we able to get the same answer? They are not talking to me at all. I don't know why. They are not talking to me at all. We shall get the same answer. We shall get the same answer. All right. Now, ladies and gentlemen, regarding this formula, please don't go to tomorrow's exam just in case they bring this Miller. Or don't go to tomorrow's exam and then you forget. There are so many formulas and I know many of them. But I would want you always to appreciate this one. I mean, there is a way you can cram it. You see, it is 3 into 3t variance all over 4i raised to what here, somebody? raised to a third. But now remember, Miller, or they made in this case here, ladies and gentlemen, that this I must always be what here daily interest rate. Daily interest rate. So if they give you like an annual interest rate of 14%, if they tell you it's 14% per annum, remember to come and divide this by 300 what year? 360 days in a year, or 365, depending on what the examiner gives you. But you see, in this question, ladies and gentlemen, I can't divide again the way somebody is telling me there, because they gave me here, they gave me here that the interest rate is 0.025% day. So per day, percent per day. So already this one is a daily rate. A good student is asking there, Mwalimu, why are you not squaring this 4 million? Remember, the 4 million is variance. And the variance is standard deviation squared. So if they give us standard deviation, like now, actually, they have even given us the standard deviation here. They've actually given us the standard deviation here. They have actually given us the standard deviation here is given 2,000 per day. So what I need to do is to square. And you see, whenever you square standard deviation, you get what we call variance. You see, if you take 2,000 squared, it'll give you 4 million. It'll give you 4 million like that. So now, ladies and gentlemen, up to here, is there some student who has been able to get some new knowledge at last minute? Anybody who has been able to appreciate this even better? Yeah, at least people are saying. So now it will be upon you to, great. It will be upon you to know whether that 100 you take it up or you use this other, So now that is upon you. You'll be able to get a video just in case you have not been able to get this concept very well. And I hope everybody used their calculator. Now, ladies and gentlemen, once you have been able to do that, remember the next thing. Now we have the spread. The next thing will be for us to get now the upper limit. Remember how Miller or how they were able to make their arguments, that this is the lower, this is the upper limit. And in between here, we have spread. We have the spread. So anytime you want to get the upper limit, that maximum amount that you can never go beyond, you simply take the L plus the spread. L plus spread. L has been given here as what here? As 8,000 plus the spread. Sorry. I can see so many messages. So in this case here, we have upper limit. It will be 8,000. It's lower plus the spread. And the spread we got there as 25,303. 25,303, like that. You see the lower limit has been given. The lower limit has been given. The lower limit has been given in this question. The minimum cash balance is 8,000. Is 8,000. All right. So anytime you want to get the upper limit, you take the lower plus the spread. You take the lower plus the spread, like that. Which then will end up giving us, the moment we go to the spread, that is it, which will end up giving us something nice. They're telling me, together we can. Yes, thank you so much. I'll be able to come to you back, Ewale. Don't worry. So in this case, ladies and gentlemen, 33,303. So this upper is 33,303. Yeah. And then I remember what Miller and Orr, remember these are two gentlemen who did this research. They came and they gave us what we call the optimal level. Optimal level. How do we get the optimal level? Because when you overstock money, you're losing. Yeah, when you overstock money, this money should be able to earn something for you. Yeah, so optimal level is normally somewhere here. They said it's a third of the spread. Optimal level is what they call the Z. So this optimal level Z will always be equal to lower plus a third of the spread. A third of the spread. Lower plus a third of the spread. That's how we get the optimal level. Yeah, optimal means very best. So the lower amount is 8,000 plus a third of the spread. And the spread in this case is 25,303. So what are we able to get, ladies and gentlemen? So we are able to get, in this case here, yeah, like the return point. Every time you go back to the return point, every time you go back to the return point, so they're getting 16,434. 16,434. So this is really 16,434. The return point every time. This will be your return point like that. This will be your return point. So now remember the question wanted you to help them craft a cash policy. A cash policy. So they wanted you to help them craft a cash policy. You're required to formulate a decision rule using the Miller-Orr model. This can be like a 6 or 8 marks. This one here, cash policy. So remember now the cash policy once you've been able to get the return point. So now you need to come and just do exactly what they have done here. You need to come and I can just read the answer here. You can see they're getting 16,433 as a return point. They said, which they said is about 16,400. So the decision rule is as follows. If the cash balance reaches 33,300, which is the maximum, the upper limit, buy 6,900. I know you know this. I know everybody knows this. Now, ladies and gentlemen, please remember, every time we must return back here. Eh? So when in this case here, you have excess cash, when you have the upper limit, when in this case here, we have the upper limit, and the upper limit in this case here is 33,303. What are we required to do whenever we have this upper limit cash? We want to return back to Z. So we must give away the excess money to the securities companies. So how do we give them? Basically, we buy. So when you are at the upper limit here, you're supposed to buy shares or money market fund units worth how much? 33,303 minus the Z value, minus the 16, 3, 4, 4, 3, 4 like that. So when in this case here, you realize you have reached your maximum, what do? It means you have got some excess cash. So you buy shares to deplete your cash, you return back to Z. What if in this case, ladies and gentlemen, you are at your lower limit? If you are at your lower limit, what will you do? You sell shares. Yeah, if at the lower limit, please listen. If at the lower limit, what will I do? If at the lower limit, if at the lower limit, if at the lower limit, this is what I will do. If I'm at the lower limit, if at a lower limit, it means you need cash. And if you need cash, what will you do? You sell shares. Shares worth how much? So now you have, in this case here, your return point, which I've wrapped my return point. So you'll come and use your return point was 16,434. You subtract the lower limit to get the amount. In this case, you're going to realize when you sell your shares. So when you are at the upper limit, you have excess cash. You buy shares. When you are at your lower limit, it means you need cash. In this case, what do? You sell shares. So the only thing, ladies and gentlemen, I can do, of course, in this case is to come and help those students who are not able to get the formula of the spread. The formula of the spread. Otherwise, yeah, so long as you're able to get a few things here and there, I mean, it's not about perfection. No, it's about JMO. It's about the ability of you to move forward. Now, ladies and gentlemen, please remember here, we are saying the spread. How do we get our spread? It will be 3 into 3. In this case here, transaction cost multiplied by the variance, all over 4 multiplied by the interest rate, daily interest rate, raised to who? Raised to a third. So this question, I know what is in the brackets is what disturbs students. What is in the brackets, what disturbs students. So 3, transaction cost is 50. Variance, they have given us variance. You see, standard deviation squared is variance. Yeah. All over 4 times then we have the daily interest rate being 0.025%. Instead of writing here percent, instead of saying percent, which will confuse you, you come and take this 100 there. That percent, take it up and it becomes a multiplication. Because you see, percent, ladies and gentlemen, is the same as saying divided by 100, which will be the same as times 100 there, times 100 there, so that you will be able to, yeah. So then in this case here, could you kindly then get your calculator, Bwana Patrick? It's really easy. And just in case if it comes tomorrow, so then please go ahead and say 3 times 50 times 4 million times that 100. Once you say equals, say divided by, you put this in brackets. Divided by, you put this in brackets. Divided by 4 times 0.025. Whatever answer you get, I don't know what it will be, it's a big figure. Whatever answer you get, say answer raised like that, raised to power a third. Put this in brackets. Raised to power a third. Now you see, you have taken care of what is in the brackets and they've been able to raise, but ultimately they want us to take whatever final answer we get times 3. Patrick, I'll be so happy if I can hear that now you've been able to get this correct answer. I'll be so happy to hear that you've been able to get this correct answer. Tell me, ladies and gentlemen, what do we have there? Yes, the return point is 16,434. Yep. So, ladies and gentlemen, then are we okay now? If this comes tomorrow, will you be able to give it some justice now? Put it now. Great. Now we are okay. Now we are okay. Now we are okay. Thank you so much. Thank you so much. Thank you so much. Thank you so much. Now, the other question that I would want to take you through, ladies and gentlemen, is this question of working capital management. And for this semester, just by luck, I hope they test this one. I don't know. I hope they test this one, ladies and gentlemen. For average, you see average, now you will take in this case here lower plus upper. You divide by what here? 3. That's average. Is not the same as what here? Is not the same as? No, just in WACC, those ones you know. Those ones you know. Again, you know, I don't want you to waste. I don't want to waste your time. I just wanted some 3 specific great areas. When they bring them, they normally confuse my students. Students are not able to harvest marks here. So the other one that I would want you to harvest marks should they bring my good students tomorrow, this concept. Yeah, this concept, should they bring this concept tomorrow, I would want you to harvest the marks there. All the marks. Yeah, please don't let I'm arrogant, but I'm not going to answer any questions that you guys want me to do there. No. This was page number, let me just get the exact page 107. If I start now getting right now WACC, WMCC, I'll be wasting your time because already you guys know those things. This is my wedding day, right? I should be the only one allowed to step on the red carpet and do whatever questions I want to do. And then I shall be able to pray for you that everything will be what here, everything will be okay. Everything shall be okay. Where is this question really now going now? Important questions disappear like that. And I would want to take this opportunity to welcome every student who is here to RCM. Next semester, do not make any hesitations. RCM is the biggest college. It is the best college in East Africa. The College of Ninjas, isn't it? Yeah. So this debt factoring. So when we talk of debt factoring, what comes to your mind? Debt factoring. Debt factoring. So under debt factoring, this is where we use receivables either as collateral, and then get a loan against them, all right? Or we sell the receivables to a third party. We sell the receivables to a third party. Ladies and gentlemen, remember the kind of business you're doing outside there, you cannot manage to do business without giving, in this case here, credit. So like, for example, I normally give you this example, like RCM, you will get, for example, our outstanding loans, not loans, but credit to students. Our receivables are like Kenya shillings 4 million. Now let me ask you a question honestly, and don't hide me. Assuming, for example, today you are a student of RCM and you happen to be having our school fees balance, and now you're going to do your last exam tomorrow. Are there chances that you will ever pay as your balance of fees, really? Be very honest. Be very, very honest. Be very, very honest. You guys are not the very best, but of course that is it. So 4 million, so automatically there is a very high chance that this amount may be written off. So then what we need to do as a college, what if, because we don't have the skills, the confidence of really trying to call each one of you, Stephen, please pay us the 20,000 that you have for RCM, somebody. If we got in this case here, for example, like, I mean, there are companies which are known like Platinum outside there for following credit, for following their debts. So if you got those kind of great companies that can easily come under, even at times in this case, they call you, they tell you, Mary, you owe RCM. And if you don't pay RCM by tomorrow, we are going to write a message to your mother or to your pastor. You know, people are very, very aggressive. They can embarrass you, you know. All right. So in this case here, if we have this particular company, which is specialist in terms of debt recovery, call that company A. And then we tell them, we have this credit book. Yeah. People who owe us, our receivables book is this. So we are giving you this particular book totally to you. So please follow those debts. But of course, meantime, because these guys are going to pay you, advance us some money. So for example, they give us like 2 million. This is what we call debt factoring. Debt factoring. When you sell your receivables to a third party, yeah, you are selling your receivables to a third party, then they give you some money. It's called debt factoring. And this debt factoring, there is what we call factoring with recourse, factoring with recourse, factoring with recourse, and factoring without recourse. Factoring without recourse. So remember, factoring with recourse is which one here? Yeah, you have to pay. Thank you so much. It will be very important. Georgia, even if you don't need my service, honestly, because this is already a service that we have been able to offer to you, and you are happy with our service, please pay us. But I know all of you paid. I don't think we have any outstanding loans. Nothing. No outstanding debts outside there. Nothing. Now, ladies and gentlemen, factoring with recourse, when you give these receivables to A, and A is not able to recover money from all students, then A will return back receivables to you. That's factoring with recourse. They return back the receivables book to you. Yeah. How about factoring without recourse? Should they go? They, in this case here, get their money from all the students, the better. If they go and, for example, get, say, money from 80%, it means that 20% are not able to pay them. They can never come back to us. So because I've seen in your past papers where they're asking us to differentiate between factoring with recourse and factoring without recourse. Remember, with recourse, this buyer of the receivables, they will be able to return back to you in the event that they are not able to recover all receivables, money from all receivables. Ladies and gentlemen, please listen. This is how they normally give you this question. Please screenshot this question, please. Please screenshot this question. Please screenshot it. Please screenshot that question. That's a very, very serious question. A company makes annual credit of 1.5 million. Credit terms are 30 days, but its debt administration has been poor, and the average collection period has been 45 days, with 0.5% of sales resulting in bad debts, which are written off. A factor will take on the task of debt administration and the credit checking at an annual fee of 2.5% of credit sales. The company would save 30,000 a year in administration costs. They save that amount. The payment period would be 30 days. It is assumed that the factor would advance an amount equal to 80% of the invoice debts and the balance 30 days later. The factor would also provide an advance of 80% of invoice debt at an interest rate of 14%, 3% over the current base rate. The company can obtain an overdraft facility to finance its accounts receivable at a rate of 2.5% over the base rate. Should the factor services be accepted, assume a constant monthly turnover. Very good. Ladies and gentlemen, when you read this kind of a question, honestly, if you got this kind of a question tomorrow, is it a question that you guys think can answer very fast as I leave you to go and do your own things? As I leave you to go and do your own things. Mm-hmm. Mm-hmm. Is this a question you guys are very comfortable with? The good thing, ladies and come again, repeat. The good thing, ladies and gentlemen, with this kind of a question, you won't get a zero. That one I know. That one I know. You won't get a zero. You may not get everything, but again, you will not get a zero. That one I know. That one I know. So we start with the current policy. Current policy. I will take less than 10 minutes to answer this, and then I'll be able to leave you guys to go and revise. So current policy. So the current policy, the organization in this case here is able to do debt administration. So in this case here, company chases. Yeah, it's what here? Receivables. It's receivables like that. Great. We are not going to factor out. Current policy, no factoring out. Ladies and gentlemen, what will really be our costs? Very easy question. This I will be able to get all. Yeah. So we are told here, a company makes an annual credit of 1.5 million. Credit terms are 30 days, but its debt administration has been poor, and the average collection period has been 45 days, with a 0.5% of sales resulting in bad debts, which are written off. The thing, ladies and gentlemen, if in this case here, ladies and gentlemen, we are going to collect, these receivables on our own, what will be the collection period? What will be the collection period? What will be the collection period? Remember, we have on paper, credit policy is 30 days. But you see, these guys are not paying us within 30 days. On average, they're taking what here? 45 days. They're taking 45 days. All right? 5 days. Ladies and gentlemen, you kindly give me, these are an overdraft. This credit you are giving here is for a few days. It's an overdraft facility. Is there somebody from this question who can give me the overdraft interest rate? Overdraft interest rate. Anybody who can give me the overdraft interest rate? Anybody who can give me the overdraft interest rate? Anybody who can give me the overdraft interest rate? Please. Because you see it's 1.5 and we're giving this money to you in 45 days. That's an overdraft. That's not a long-term loan. So I'll always use overdraft interest rate. Because you can see here, the factor would also provide an advance of 80% of invoice debt at an interest rate of 14%, 3% over the current base rate. So meaning, ladies and gentlemen, that the current base rate, the current base rate will be 14% minus 3%, which gives me 11%. We read again. They're telling us here that invoiced at an interest rate of 14%, 3% over the current base rate. So the current base rate will be 14% minus this 3%. The company can obtain an overdraft facility to finance its accounts receivable at a rate of 2.5% over the base rate. So meaning that for this kind of mathematics, ladies and gentlemen, we shall always use the overdraft rate. So the overdraft rate will be 11% plus 2.5%, which gives me 13.5% for a whole year. So then the costs. The very first cost that I need to consider will always be the opportunity cost. Opportunity cost. I'm losing money for having my money with my receivables. This is money that I should have invested in a money market fund. So there will always be opportunity cost at the rate of interest of the overdraft, at the overdraft rate. So remember the amount which is outstanding owing is 1.5 million. And we're using, ladies and gentlemen, in this case here, the overdraft rate, which will be 13.5. Remember this for a whole year. And then remember our average credit period is 45. They haven't told us number of days in a year. It can only be proven. We make an assumption of 360. So remember, ladies and gentlemen, if in this case here, these guys paid us, and then I had this money as excess in my company, I would have invested this in the short term. I would have invested this in the short term markets, overdraft markets here, and I would have earned that. So then, ladies and gentlemen, what figure are you able to give me there? Please talk to me. I can't see guys giving me. Oh, this new concept, what do you mean? You must have done this really. So 25, 313. Just give me whole numbers, 25, 313. Give me whole numbers. 25, 313. Now, let me ask you, okay, it could be a new concept to you, but do you guys agree with me that you may have seen this kind of questions in your past paper? Anybody who is able to agree with me that there are these kind of questions in their past papers? Anybody who is able to agree with me that they have seen? Working capital management, receivables, it is there. It's big. It's big. Not advanced. Yeah, the cost benefit analysis. Cost benefit analysis, we have this. Okay, then the better question to ask, somebody is saying hakuna. Hakuna. Kwa hivyo tuachane nayo sasa, ama tufanyaje? Inakaa MA. Tuachane nayo. Yeah, I don't have a problem. Ukisema hakuna, maybe mi naota vitu yangu. Outside the box, yes. Now, ladies and gentlemen, should we continue with this credit policy? Should we continue with this credit policy? Then which costs are we looking at? The first cost that I'm looking at, for my money being outside there, I'm going to lose. I would have invested this in the money market. So there is an opportunity cost. There is an opportunity cost for my money which is outstanding there. So which these guys have given me a figure of 25, 313 like that. 313 like that. Now, ladies and gentlemen, please listen and listen to me very well. If I continue chasing this money myself, do we have any other cost that we shall incur? Oh, yes. Because you don't have experience of chasing after these debts. So we expect in this case here, we expect bad debts to be there. Bad debts to be there. Because you're not an expert. So bad debts, ladies and gentlemen, then this one here will give me how much? Bad debts will give me how much? You can see here, it's a straightforward thing. But its debt administration has been poor, and the average collection period has been 45 days, with a 0.5% of sales resulting in bad debts, which are written off. So then bad debts will be 0.5% of credit sales, and our credit sales is 1.5 million. So 0.5% times 1.5 million, which will end up giving me what figure? Because remember, this is what is outstanding. So bad debts, what figure are we able to get there, my good students? I'm alone, but I'm overcoming just in a few minutes. In a few minutes, we shall be good to go. So we are getting 7,500. Do we have any other money that we shall incur? Any other expenditure we shall incur? Oh, yes, admin costs. We have administration cost. So administration cost, what have they given us? They will give us a figure. Administrative costs, ladies and gentlemen, they will give us a figure. Uzuri kitu nimekufunza, utaitumia across board, utatoka bure. So we are told here that admin cost, debt administration cost has been poor, and the average collection period is like that, with 0.5% of sales resulting in bad debts. A factor would take on the task of debt administration and a credit checking at an annual fee of 2.5% of credit sales. The company would save 30,000 a year in administration what year cost. The payment period would be 30 days. Now from this, are you able to give me the administration cost? I'm giving you 1 minute. I'm giving you 1 minute. I'm giving you 1 minute. In fact, I will take the task of debt administration and credit checking at an annual fees of 2.5% of credit sales. So they're telling you basically, ladies and gentlemen, if you don't involve this factor, you will be incurring that figure. A factor will take on the task of debt administration and a credit checking at an annual fee of 2.4. So if we continue doing it ourselves, we're going to absorb this cost ourselves. 2.5% of the 1.5 million. That will be the administration cost, which debt admin cost, which will fall on us. Which in this particular case, ladies and gentlemen, will end up giving us what figure? 37,500, and that is it. So then come here and give me the total of running this exercise within the firm. I'm so sure the only cost that most of us will forget is this opportunity cost. But you see, if you're a bright student, you'll end up getting these bad debts. Yeah, you'll end up getting something there. So they're giving me something there, ladies and gentlemen. What are they able to give me there? What are they able to give me here? Thank you so much. The other option, ladies and gentlemen, is for us to go ahead there, and then we do what, ladies and gentlemen? We give this to a factor. Let's give this to a factor. So if we give this to a factor, what will be happening? What will be happening here? If we give this to a factor, what will be happening? Let me see the argument. So proposed policy, factor out the receivables. Factor out the receivables. Proposed policy,